Hey guys, welcome back to the Real Estate Monopoly. My name is Kerwin Donis. Today on the show, we have Sandhya. Sandhya, if you could please introduce yourself to the audience and tell us a little bit about who you are and where you are right now.
Thank you so much for the honor of being on your podcast, Kerwin. It was great to meet you in person. My name is Sandhya Seshadri. I'm a Dallas-based apartment investor. Like most Asian geeks, I started out with a background in electrical engineering, so math was definitely my strong suit. And I worked in the corporate world for a while. And then I also went into the stock market because of my MBA background. But right now, I wanted to save on taxes, and that's what led me to multifamily. I was looking for a way to get into real estate, but I didn't have a handy person background to be able to fix things, and do fix and flips kind of stuff. So when somebody told me about multifamily, that you could buy large apartments and have third-party property management company do all the day-to-day work of leasing and maintenance, and I would be more of an asset manager, monitoring KPIs, making visits as needed, etc., it made sense. So I joined a mentoring program that helped me scale quickly. So my first deal was like 86 doors. And now, my most recent one was like $29 million, 253 doors. So I have over $100 million worth of assets under management. My base is Dallas, Fort Worth, where I've lived over 31 years now. And so I really know my local market well. So that's my area of expertise, if you will. If you give me an address in Dallas, I can tell you right away if I'm even interested in the property. But I also invest on the passive side a little bit with my retirement account. And then I use my regular cash account to buy my properties slowly. I don't have a specific number of deals or number of doors. If the deal makes sense and I can see the value I can add to it with the least risk, then that's how I choose my properties. So they're all in the Dallas area. And I love this business.
No, that's awesome. And you mentioned you're in the Texas area. We travel there a lot for like events, and you guys are really lucky because you guys have a lot of multifamily conferences there. And I mean, it was funny
Yep.
because a lot of people finally had to come to Charlotte, North Carolina, like in our
Yeah.
territory for the first time. And now they know what it feels like to travel hours to get to
Yeah.
conferences and stuff. So awesome. Thank you so much for being here. I'd say we just go ahead and get into it. Starting
Sure.
out today, I really wanted to dive into like the asset management side of things, particularly
Mhm.
how you're approaching it in your business and what your perspective is on it with these uncertain times that we are encountering right now. So starting out for anyone that might not be maybe well versed in what asset management is, can you just provide like some context into what asset management is, what it maybe involves, and why it's so important to really hone in on asset management, especially during economic hardship and times of economic uncertainty?
Asset management is basically executing the business plan that you came up with in the beginning when you underwrote a property and said, hey, I'm going to go do these 5 things, for example, on this property to force appreciate the value of the property so that I can make it a better community for my residents, but also return a great profit to investors, right? So asset management is where the rubber meets the road. You've done all this theory and everything on paper. Well, now it's time to go execute this plan. So you want to make sure you have full 100% alignment with your property management company that's going to run this property for you in understanding your business plan and executing it the way you want to. That's the first and most important thing. Once they're bought into your business plan, you've agreed on your targets. So you manage and you monitor some KPIs, right? So a basic KPI would be revenue. What is my top line revenue collection for the month? That includes my rent and my other income sources. And then you want to monitor the expenses. So ahead of time, before you even buy this property, make offers on this property, you have an agreed upon budget with your property management company. So you want to make sure they stick to that budget in terms of controlling your expenses, right? That's a very important piece of it. So if you
Mhm.
keep working on increasing your revenue, decreasing your expenses, then your NOI, which is the difference between revenue minus operating income, your NOI, net operating income, goes up. And net operating income over divided by the cap rate is the value of the property. That's what you want to force appreciate. So as an asset manager, you make sure you work well with the property management company to execute the business plan, monitor your key performance indices, KPIs,
Mhm.
like your revenue, your expenses, your net operating income, your vacancy, your delinquency, and similar metrics like that, so that you execute and make money for investors while improving a community. And that, in a nutshell, is the role of the asset manager. You don't want to be micromanaging the property manager. You don't want to take over that role. So if you've been doing single family or self-managing your properties, it's time to step back and have more of a helicopter view of everything and monitor those financials, especially on a monthly basis. And you only want to get to the invoice level if you're suspecting a problem. On a daily basis, you don't want to be checking those. But you've got your expenses, so you know on a monthly basis, this is what my bills need to be, whether it's my utilities, my admin expense, etc. So you already have those numbers with you, and you only want to monitor that on a monthly basis, unless there is a problem. But trust but verify. So as much as a property management company was going to tell you, hey, this is it, they say all the right things, you want to be monitoring that closely till you have established a strong working partnership with them.
Yeah, no, that's awesome. And it's funny you mentioned that because it seems we've been in multifamily for almost 2 years, and it seems like we've come across a good amount of sponsors who are doing deal after deal. And it doesn't seem like maybe I'm not saying they're not putting like emphasis or importance on the asset management, but it's not as sexy and talked about, you know? So it's really interesting to kind of get your perspective on it, because you're right. It is kind of when the show starts, you know, that's when you're just getting started.
Yep. That's when you need to return and do your fiduciary responsibility to investors. So for a lot of people at the upfront stage, when they acquire a property, that acquisition fee is what's most sexy. And that's their salary for the year. So they keep on acquiring more and more deals, focusing on, hey, acquisitions. I'm an acquisition specialist. I'll take my acquisition fee. The deal closes in 60 days and I'm going to run away. Well, if you don't execute the business plan, those investors are not coming back. So you'll be constantly chasing new investors. So one of the questions to ask people is, before you invest passively or you co-GP with someone, what is your asset management experience in that location, in that market, in a similar type of asset? And that's when you know those are the people in charge of the deal from when the deal closes till the end, right? So you want to make sure they have the experience you need.
Yeah. And so I know a lot of other investors, they emphasize the importance of having cash reserves. And I believe you've mentioned that. I had the honor and an opportunity to see you speak on the panel at the MFIN Con in Charlotte. And it was awesome. And that was when I was like, I need to have her on my show. So I'm really glad. Absolutely. But if you could kind of provide some insight into how you're approaching cash reserves, and are you kind of maybe keeping more gunpowder right now?
So in general, I came here as an immigrant with an $8 a week kind of food budget. So always looking for bargains and being very careful with my spending has been the way I've run my properties all the way from the good days of 2019 and 2020, et cetera. So it's not something new that I'm doing now. But in terms of executing the business plan, we only spend as minimal amount as needed to upgrade the units to get to our pro forma rent. So just because I have a budget for 10K per door or 15K per door in interiors, do we really need those interiors to be that fancy to get the pro forma rent? Do tenants appreciate that as a feature? Or maybe I can keep those funds as reserves to repair the plumbing problem that could come up next month, or a winter storm like we had in Dallas that's going to, almost flood the unit, right? Yeah. So having cash reserves to repairs those things is very important. So the older your vintage property, the better your physical due diligence, the more cash reserves you always want to have. So it's not just for your mortgage payment increasing, right? Because if you're under bridge debt right now and these interest rates went up, your mortgage just went up by anywhere from 10, 20, 30, 40K per month, right? So do you have the extra cash flow? Have you executed your business plan to where you're cash flowing that well to afford this additional monthly expense? And if not, better have some cash reserves, because otherwise you're going to end up having to make a capital call, which is a terrible thing to do. You'll never have investors coming back if you do that. So cash reserves are always important. And the older the vintage, the more your repairs are going to be, the more unexpected your repairs are going to be. And depending on your relationship with inspectors and the city, et cetera, they may not allow you to grandfather certain things like electrical work, for example, back to the old standards. And for you to bring it up to code for today's code, that could cost you a fortune. So, yeah.
Yeah. No, I know. I in one of your other interviews, you mentioned that you had a sponsor essentially do that call money for money, and so I mean, I'm sure you're not investing with them again.
Oh no, But
Yeah.
they're pretty successful, except they're not going back to the same investors.
Mhm.
They're chasing new investors each time because once they get their acquisition fee, they're not paying attention to the asset management side of things.
Yeah, no, that's interesting. Um, so I know you also, I think you don't have a construction background, is that right?
I don't have a construction background, but I partner with people who
Mm,
do. And we always
awesome.
hire a due diligence company. And now that
Okay.
I've done several deals already, I have a pretty good idea of what the estimates would be for certain projects.
Yeah.
And I always get 3 estimates, and I always like to check with other peers in
Mhm.
the group. So I'm part of a large mentoring group, but I also network extensively at conferences. So
Mhm.
you always go to preferred vendors who have gotten a thumbs up for doing the exact same job in your local area, and we only get them in to do our
Yeah.
work. So that's how I do my verification and make sure I'm not overspending on a CapEx project.
Yeah, no, that's awesome, and that's kind of what I was hoping to get because a
Mhm.
lot of times asset managers and operators don't have that construction background, and that might be a limiting belief that they need that in order to be in that
Mhm.
role. So, can you come just expand on? Let's say you don't have that construction background, or you don't want to go work in construction for 5, 10 years to get it. What would you recommend, and maybe expand on what you did?
You would just figure out from peers in the industry how much a job like this should cost you. Let's say you're planning to do exterior paint. The paint itself for a certain number of buildings might cost you a fixed amount,
Mhm.
but they might find additional repairs to be done with the framing, et cetera, as they go about it. So you always want to have a partner or some other peers who can double check those numbers for you if you don't have that background. It's just like I see a lot of people saying they're afraid of math and they don't like to underwrite numbers. Well, you want to have a team member then who's a very strong underwriter. It's just like that. So whenever you form teams together, you shouldn't find people who are just like you. In fact, you should find people who think differently from you and who have complementary strengths from you. So when
Mhm.
we do a due diligence, full physical due diligence, we actually hire a company to do that for us. So Omni Assessments, for example, is one of the companies we've used several times on our deals. And so they bring all these contractors on the day of physical due diligence, which is well before we close. So we already have the list of CapEx projects we plan to do and an estimate for those. So we know it's going to cost only so much. And once you've done a few, you know how much pretty much it's got to cost. So use the leverage the strengths of others. There's never going to be a day when you know everything you need to know about getting into multifamily,
Mhm.
because there'll always be surprises. So make sure you're well networked. It's who you know, it's not what you know, right? So who,
Absolutely.
not how. So connect with peers who have complementary strengths than you. So they'll be your references.
So, how have you and your partners right now, especially with the rising construction costs and the cost of labor, how are you guys mitigating those increasing costs? And have you experienced like delays in projects? And how are you keeping those projects in your kind of value add game plan on track?
Surprisingly, we have not had delays, and my projects are all in the Dallas-Fort Worth area.
Nice.
We have done projects from remodeling washing machine, adding washing machines, remodeling laundry rooms, tons of interior upgrades. The other one is, of course, exterior paint,
Hmm.
framing, signage, etc. We've not actually been experiencing a lot of problems. The only time we had a problem was when a boiler went out and we were out of hot water at this property, and the parts took about 3 days to come in. So we basically did something nice for the residents and apologized profusely for it. And it's hot in Texas. We have a pool in that property. They kind of said it's all right,
Awesome.
but I haven't had any other major issues. The other thing we do is we have multiple vendors. So if one vendor is out of something, then you just go to another vendor and see if you can work something out with them. And let's say we were planning to do a project of replacing all our air conditioners at one property. We only had enough to replace maybe the about 30 or 40 instead of the full 150. So we handpicked the ones that were the worst performing air conditioners, right?
Hmm.
And we did those first before the summer season hit. And
Yeah.
so while we were waiting for the rest of it to happen. So you find workarounds, you get creative, right? When you're
Yeah.
presented with challenges, right? You're given lemons, you make lemonade kind of concept.
Absolutely.
And
And
the connections really help.
100%. We found so much value in just networking, going to conferences, meeting people, and it's kind of cool because you never really know. Like, you don't approach these relationships with like expecting something in return, but you never
Mhm.
really know when you're going to need someone. So you meet like a contractor one day, and then a few months down the road, you end up meeting them, and you remember you know them. So
Mhm.
that's so important. And kind of touch on that third party relationship. I believe you do outsource that third party property management. Is that right?
Yes, and the
Awesome.
property management company has a huge list of contractors, typically themselves. So when we're in a pinch, they can always, do something because they run several
Mhm.
properties in the area too. So they can assist with that.
And so what in what ways are you kind of having oversight over your property management company? And you mentioned the KPIs earlier. What are some of those in terms of their performance and also with your CapEx budget, making sure construction's staying on track?
The most important KPIs again are always your top line revenue collections for the month, because that's a number that nobody can change with their accounting
Mhm.
practices, etc. Like how much did you collect in rent and other
Mhm.
income for the month? And then you look into the categories, right? Especially in your rent, you know how many rents are at pro forma and how many are below. You want to anticipate the renewals coming up. You want to make sure the renewals are at pro forma, but you also only want to renew the residents who are going to be able to pay your higher rent, right? So one of the things you always want to do is a lease audit. On a periodic basis, you want to do a lease audit. You want to ask for proof of income of these residents so that they can pay the rent that you're going to charge them for the upgraded units, as an
Mhm.
example. And same with new leases. So another KPI is always expenses. So every expense line item, why was my admin cost higher? Why was my personnel cost higher? Oh, we lost a maintenance guy and we had to hire temp personnel who charges us more. Okay, so how can we save money somewhere else so that our total expenses for the month don't increase, right? So the minute you're getting temp personnel, your monthly personnel expenses are going to go up. So you find another way to save on the operating expenses somewhere else, right? You
Mhm.
slash it somewhere else. So that's how you balance the budget, just like with any organization, but you're doing it on a larger scale because this is, 200 door property. So just like you would do in a single family, but take it on a larger scale. You always want to monitor your NOI, net operating income. The way you do that is you look at the list of expenses and make sure that the ones that are one-time expenses are considered what is called below the line expense. Like I had a major, my boiler went out and I'm getting a new boiler in. Well, that's clearly a one-time expense. It's not a monthly operating expense. So you want to make sure that's classified as a below the line expense so that your NOI looks good. And that's what you want to increase the value of your property. Beyond that, you want to look at basic things like occupancy, right? How is your occupancy trending? Now we're in July, this discussion is going on. July is your peak leasing season. So before school starts in August, at least in Texas, you want to make sure your units are as filled up as possible. You don't want to go into the off-peak season, which is your fall going into the holidays, and have a lot of vacancies. So now is the time that you want to quickly do those turns and get people in. And then let's say maybe you have 10 vacant units in December or January. That's the time you might want to take a little longer, do nicer upgrades to attract the tenants in there. So vacancy, occupancy, delinquency is a big one. So you don't want to have a lot of delinquency in your system. So what is your plan to address delinquency? That's a conversation you have with property management even before you buy and close the deal, right? Way up front, and say, okay, what is your process? Is this property manager aware of the way to do evictions? When do you go file for evictions? What happens if you took a $50 as a partial pay when the tenant really owes you $3,000? Well, in certain counties, right, that kicks you another 30 days. That buys the
Mhm.
tenant another 30 days to go and before you can file an eviction. How well versed is your property manager in these kind of details, right? That's very important because if you're in a recession and some of your residents can't afford to pay the rent, what forms of rental assistance is available to them? So be aware of all the local counties and other organizations nearby that offer rental assistance, right? So we had the Texas Rent Relief for a while through COVID, but that stopped. There are still other local programs that would help them. So you want to make sure you have a plan to address delinquencies as you go into a recession. So the top line revenue, your expenses, your net operating income, and then ultimately your net cash is also important. You want to be net cash flow positive.
Mhm.
So if there was a capital expense involved and it's written in your regular balance sheet and your income statement, you want to make sure you transfer that money from a CapEx account or you do a lender draw so that the net cash is still positive in operating the property. But those would be
Awesome.
some of the most important metrics you want to follow. The second set of metrics I want to continue a little bit is your rent itself. Have you done enough competitive comparative shopping on a regular basis? Your property management company should be doing that so that you know if you need to adjust your rents accordingly. Maybe 2 bedrooms are more popular than studios, as an example, right? So you want to make sure you're charging what a competitive property nearby is charging, which has similar amenities, right? And it's a similar vintage. So the nice looking A-class new build property might be charging $300-400 more for that vintage. So that's not a fair comparison. So you need to be aware of that. But if you're not comparative shopping, at least on a quarterly basis, then you might be missing out on some rent opportunities or other income opportunities.
Oh, that's awesome. There's a ton of value just dropped there. So thank you. Thank you. That's awesome. And I know that you're big believer in kind of adding value into the community and actually investing in the community and in the residents that live at your properties. And I was really, impressed by that because I don't think that's very, I mean, I've heard it happen, but I don't hear every sponsor talk about that. Can you maybe, to someone that might say, oh, that's like maybe a waste of money, or there might not be a direct ROI on that. What is your response to that? And can you maybe touch on what you're doing?
I think relationships and people are everything, and that includes your residents. Your residents are your customers. They're your number one customers. If you don't have people who need to rent a place, you're out of business. So you got to take care of them. That means you got to be timely in your work orders. But we like to do a resident activity, even if it's a little thing. Like all we're doing might be just giving out popsicles on a hot summer day in Dallas. But it just brings the community together. It opens that conversation so that, let's say they have a problem with paying rent, then they can have that open discussion with the property manager. They can relate to them and connect with them a little bit better. But like back in COVID, like in 2020, when we had our property with that we were managing, we did like a free Thanksgiving turkey. And then, in the summer, we wanted to have a barbecue picnic kind of thing, but because of COVID's restrictions, we couldn't do it. So we made up goodie bags and hung it on the doors of every apartment with things like toilet paper that was a shortage back then. But it's just a way for you to connect better with your community so that when we had a delinquency problem with COVID shutting down so many places, restaurant workers, et cetera, losing jobs, these folks came up one at a time, socially distanced, outdoors in our community area, and filled out the applications with the help of our leasing manager. So all of their bills got paid. And we wouldn't have had that relationship with them if we hadn't been doing community activities. So financially, our delinquency, actually, we only had to evict one tenant in that property, which was, an 86-door property out in Cleburne. When we had this connection with all of our residents, our delinquency wasn't a big problem. We sold that deal in 26 months with like a 3x kind of return to passive investors, which is pretty crazy, right? To get those kind of returns when the bulk of your hold period is COVID. So it is a direct impact. When you have a connection with your community, you listen to the problems. You'll have residents talking to you, telling you the problem tenants that you maybe don't want to renew, but also about the good things happening or where we need to prioritize. So nothing like feedback from your customer to improve your customer service. And remember that residents are your customers. It starts there. And then your second customer, who's equally important, is your investor who helped you buy this property in the first place. So you take care of your customers in both places, and you're going to have a win-win situation.
Absolutely. And so I know right now, things are kind of uncertain and people aren't really sure or what's coming. And of course, with any property, I guess, maybe, I don't know, I'm assuming your end goal is to sell or refinance at the end of your hold period. Can you maybe touch on what would happen if cap rates aren't really where you wanted them to land around that time? Like, how do you mitigate for a potentially higher cap rate on exit?
You always start with your underwriting. So your underwriting has to be with an exit cap that's higher than your entry cap. So the deal that I told you was so successful and we sold it with 3x money, we had underwritten for a 2 basis points higher, like 200 basis points higher. So we had a purchase cap of like 5 something and our exit cap was 7 something. And of course, exit cap was only actually 5.5 when we sold it. So we made a good amount of money, but you have to make sure you underwrite for a higher exit cap, meaning worse conditions. And if you didn't do that, yes, you could be in a situation where you may have to work offline with a broker and see if they can find a buyer for you who would accept it. Because there are people with 1031 exchange kind of situations who need to identify a property. So you may have to go slightly lower on your price, but I would get out of a situation like that if you were stuck, right? Yeah. Where the cap rate isn't where you need it to be to make those returns, right? But with every month, you might be losing money, et cetera, kind of situations. And, as a potential buyer, I'm looking for those kind of deals the next 6 months where buyers found that this bridge debt is too much for them and they were hoping to refi today. That's not going to happen because the interest rates are higher, et cetera. So that's the kind of potential where I want to go in and say, okay, look, let's make a win-win situation for us both. I'm going to get this deal at a slightly lower price and I know exactly what to do with it. But
Yeah.
I'm going for a fixed interest rate this year in all my properties, just for that reasons. And I like agency debt. It means the property is already stable to qualify for agency debt versus bridge debt. So my advice to anyone having a problem and not able to and needing to sell in the next 12 months, but the cap rate and final price isn't cooperating, is reach out to brokers right away and try to sell it off market to potential buyers. And that's the way to get out of such a situation.
No, that's an awesome piece of advice. I appreciate that. And throughout your conversation right now, you haven't really mentioned like a lot of the value add strategies you're using are forced appreciation. And I haven't heard you say you're relying too much on rent bumps. But of course, you do at some point. But can you maybe explain why you shouldn't assume or include large rent bumps in your underwriting?
You can only assume or include rent bumps in your underwriting if you have done a thorough research of the comparative properties nearby and the median household income can support it. So if your median household income is 40K and your highest pro forma rent is $1,500 a month times 12 makes it 18,000 a year. Well, 18,000 times 3 is 54K. So if it's 54K median household income, they can afford it. But if it's only 40K, you're going to have delinquency problem. So that's where you got to get realistic about, even if a property nearby is trying to charge that kind of pro forma rent, can your tenants really pay that? So in that location, this is how much you can get as a rent, right? Regardless, you can't change the location in a property. And that's where that comp analysis, knowledge of median household income, very close scrutinizing and screening of tenants, et cetera, is very important for you to realistically achieve those rent bumps. So if you are operating a property with very similar vintage within a 1 mile radius on the same side of the highway, even little details like that make a difference, then you could confidently say, I can get $100 rent bump by doing this. But right off the bat, if you say $300 to $400 rent bump, just because I'm in this location, well, if your median household income doesn't support it, you're not going to be able to collect it. And that's why that assumption has to be validated with data by not just you, but the professional property management company who wants to run it for you, who hopefully has that local experience from running a property nearby and says, yes, I can get you that rent bump if you do this and this and this.
Yeah. And so I during that panel that I saw you do, I was really, just amazed by all the smart speakers, but especially you, you seem very well versed in the economic, where we are headed in terms of the real estate market and the economy. So I'd love to know, just pick your brain personally. Where do you see the real estate market headed in these uncertain times? And can you maybe tie it back to what asset managers that are currently holding properties and in charge of other people's money, what can they do to kind of weather that?
So today we're in July of 2022. I believe that in a year's time, our interest rates will be the same or less than what it is today, because in anticipation of an election year, it's like how the pendulum swings. Our administration, political parties, they've printed too much money in a short amount of time. So 50% of the money in circulation was printed within the last 3 years. And so we went too much one way. So now to balance that, they're swinging the other way. It's not just the rise of interest rates, right? Like 4 years ago, 2018, 2019, I mean, 5%, 5.5%, 6% was pretty reasonable for an interest rate. And if you look at historical data, what happened was they did it too quickly. And so everybody's in shock because, oh my gosh, what are you trying to do? You're applying the brakes too much. And this happened too quickly. So they're slightly overdoing it. Inflation is definitely there. So it'll come back again. So the pendulum is going to swing both sides a little bit before it settles down. But even today, my interest rate is slightly lower, and we're talking July 8th, than it was 3 weeks ago, right? So that's a little thing that just swings all the way around. As an asset manager running a property and responsible for other people's money, you want to be careful with your spending. You want to be well capitalized, regardless of the class of asset, but especially with older assets, because you just never know what could break down and cause repairs. So if you can get a $50 rent bump doing nothing, I would do that over a $100 rent bump spending 10K on an interior. See, that would be my strategy. Another way of mitigating this risk is, instead of doing 12-month leases, you could do a 6, 7, 8-month kind of leases and stagger those leases so that you don't have 15 units getting vacant all at the same time. So look closely at your rent roll. Always have more leases expiring in peak leasing season, which is from March through, August, if you will, rather than around the holidays. So if you look at your rent roll right now and look at where the leases are expiring, try to do something to offer them, maybe make them 13-month leases if they're really good paying tenants. So I would address your delinquency. I would control your expenses. Look at those cable bills or any other monthly bills you're paying on a regular basis. Do you really need to be paying that much, or is there a way to cut back? If this was your household, right, just take it as your household budget. Where would you cut back? Do you really need that country club membership as an example, right? If you suddenly lost your job or your main source of income, what are the normal steps you would take to cut back? So do the same thing, be careful. And if it turns out that your property is doing just fine, you didn't have to cut back so much, well, go back to spending, right? So it's rather better to be safe than sorry and that kind of thing. So plan, okay, next 12 months, this is the amount of distributions I projected to my investors. Am I going to be able to get that from my operations, cash flow from operations? And if not, what can I do? What is my gap? Is it 5K a month? Is it 10K a month? My mortgage just went up by 20K a month. Where am I going to find that money, right? Do I have to search on my couch for those pennies? So what is your way? So take it head on. Figure out what your maximum interest payment could be if the rate cap goes up. And so what is the gap that you have to, reduce so that you can still make a distribution to investors and operate the property without making a capital call, and go through line by line of that income statement and talk to your property management company. They're your partners, and say, where can we cut back? What is really necessary and what is not? And only do CapEx projects that have an immediate ROI, rather than, okay, the payback period on this is 3 years later. Well, let's just do the ones like, if you have an all bills paid property, water conservation makes sense right away, but maybe not a fancy, I don't know, grill, pergola, picnic area, etc., unless it really looks bad. It really looks terrible, right?
Mm-hmm.
If it ain't broke, don't fix it. And if you don't have to do a full upgrade, don't do a full upgrade, unless you're getting ready to sell. And even then, get the broker's input on that.
Awesome. No, and that's kind of cool because it seems like there is some space for creativity. There's no, it's an art. Underwriting is an art, but it sounds like asset management, it's also an art. That's awesome. And it is time for our speed round. Are you ready?
Sure.
Awesome. Okay, let's get into it. So question number 1, what has been your biggest failure or learning lesson throughout your real estate journey? And what did you take away from that experience?
Investing in a sponsor without digging in deeper, and I have a whole podcast episode on this, but basically ask for references from other passive investors in their past deals before sinking your hard-earned money as a passive investor or as a co-GP. Raising money for someone who doesn't have a strong reputation as verified by a prior passive investor.
That's awesome. And it seems like I can think like some sponsors might be like, oh, that's annoying. But if that's the case, then just move on.
Not worth your time. Move on.
I love that.
Capital is very special these days.
Absolutely.
So if they're not willing to give you a list, they brag about, oh, I own 3,000 doors. Well, give me a list of properties. Don't just tell me your best performing properties. Let me see the whole list that adds up to 3,000 doors, and give me a passive investor reference and tell me which is your best deal and which is your worst performing deal today. Have you made distributions on time on all of these dates as you projected? Show me your initial projections on these deals versus today's actual performance. How long have you held it? Have you had a full cycle?
That's
Ask
awesome.
all those questions, which I didn't. And that's why that deal almost lost money.
Yeah. I appreciate you sharing that experience, because I know people in the audience are going to learn from that and avoid any of those mistakes. So that's awesome. And moving forward, what is your long-term vision for your business, and what are you aiming to accomplish in the future?
I would like to have larger and fewer properties so that's how I grow and scale. But I don't want to have a dozen properties that I have to immediately worry about. I'd rather have 3 properties that are larger, in which I can do the same thing, where I spend the time I need to spend. I visit all my properties on a weekly basis. I want to still be able to do that. And so I want to improve the communities. I truly want other residents to be jealous of our properties and want to move into our properties. That's my goal.
I love that. What is your why that drives you and just motivates you to be awesome?
My biggest why, I think, is seeing the joy in people's faces when we do these community events, but also the happy messages I get from investors when, their money is more secure. I mean, today is July of 2022. And most people I know from January 1 till today have lost at least 20% of their money in the stock market. And instead, I continue to make distributions on my deals. So having those happy investors, it's the feel good side of the business, right? You're improving so many lives with this. And this is a service where we're helping residents find a better, safer, cleaner, nicer property to stay for about what they would pay for a really fancy new property, you know?
Absolutely.
And they pay a lot less. So that's great. And then the investor side, hey, yours, the investment is secure. You can pay for the kids' college in 5 years because this money will come true in its, projections.
Yeah, no, we had the opportunity to kind of give distributions out not that long ago, and it was
Mhm,
really good timing because the stock was crashing. So it's like,
mhm,
it's good timing, and it's also I think a lot of times sponsors might have this misconception that they're asking people for money, and like there's an infinite amount of multifamily opportunities when in reality there's a lot of people invested in stocks and investments that are actually negative yields and just not even putting any money in their pocket. And so we are the prize, I guess, is what I'm trying
mhm.
to say.
That's right. We're providing value. And it's just like, maybe I'm opening a restaurant that offers Chinese food. If you don't like Chinese food, fine, but refer your friends who like Chinese food because you know what? I'm one of the best Chinese restaurants around, as an example. And
Absolutely.
so
That's awesome. And you shared a ton of wisdom today that I really appreciate it. But if there was one thing, one piece of advice or wisdom that you'd want someone to walk away with from today's episode and conversation, what would that be?
persistence, don't ever give up. If you don't find a way to do so, whatever your goal is, in the way that someone else has done it, don't worry. You can blaze your own trail. You don't have to follow someone else's path, but don't ever give up on yourself. With each failure, you learn something new and you use that to do even better the next time around.
Awesome. Thank you so much for your time. I really appreciate it. I learned a lot, and I know my audience is going to get a ton of value out of this. If anyone wants to learn more about you or just follow you on your journey, where can they go to find out more?
I'm active on both LinkedIn as well as Facebook. And my website is multifamily4u.com, where it's the number 4 and YOU spelled out. So multifamily number 4 YOU.com. They can put their email address and send me a quick message or ask for my checklist of how to vet a sponsorship team. See, I had a failure. I learned from that. Now I developed a checklist that I share with people. So
I
you can
love
do
it.
better on your next deal.
I love it. Well, it's awesome. I'm definitely excited. I'll make sure to include that in the show notes. Thank you so much for your time, Sandhya. It was a pleasure chatting with you.
Thank you for the honor. Appreciate
Absolutely.
you.
Yeah. And if anyone wants to check us out on our YouTube channel, we have a YouTube channel, and we also would appreciate a 5-star review. And if you want to leave a comment, we would love to hear from you guys. What are you guys thinking? What do you want to hear? Please get out there and take action. Have a great rest of your day, guys.